Welcome back to our channel, where we share valuable tips and advice on personal finance. In today's video, we're going to reveal the secrets to paying off your mortgage faster. If you are tired of being burdened by monthly mortgage payments, this video is for you. So, let's dive right in. Have you ever wondered why there's a special joy and contentment that comes from being in your own house? Our house are spaces where we can truly be ourselves, surrounded by familiar belongings and cherished memories. Being in our own home evokes a sense of security and emotional well-being. It's a place where we can relax, unwind, and feel completely at ease, free from the expectations and pressures of the outside world. Owning a home is often also seen as a significant milestone and a symbol of accomplishment. It represents years of hard work, dedication, and financial stability. The feeling of achievement that comes with home ownership brings immense satisfaction and a sense of pride in one's accomplishments. However, for the majority of individuals, purchasing a house entails obtaining a loan from a bank and agreeing to make mortgage payments over an extended period of time. Unfortunately, this can gradually become a significant source of stress and concern for many people. In this video, we will delve into several approaches that individuals can adopt to accelerate the process of paying off their mortgage. By implementing these strategies, individuals can work towards a faster mortgage payoff, ultimately leading to a future that is more secure and free from financial stress. Paying off a home mortgage is a long-term aspiration for numerous individuals. When it comes to mortgage payments, there are typically two main components: the principal amount and the interest. Let's break down these two parts further for better understanding. Principal amount. This refers to the initial sum of money that you borrow from a bank or a lending institution to purchase a property. For instance, if you take out a mortgage loan for $400,000 to buy a house, the principal amount is $400,000. Over time, as you make your mortgage payments, a portion of each payment goes towards reducing the principal. Interest. The interest is the cost charged by the lender for lending you the money. It is a percentage of the outstanding principal balance and is determined by factors such as the prevailing interest rates, your creditworthiness, and the terms of your mortgage agreement. The interest is the lender's way of earning profit on the loan. When you make your mortgage payment, a portion of it goes towards paying off the interest accrued on the outstanding loan balance. It's important to note that in the early stages of a mortgage loan, a larger portion of your payment goes towards paying off the interest, while a smaller portion goes towards reducing the principal. As you continue making payments over time, the proportion shifts, and more of your payment is allocated towards reducing the principal. By paying both the principal amount and the interest over the course of your mortgage term, you gradually repay the loan and eventually become the sole owner of the property, free of any mortgage obligations. To illustrate this, let's consider an example. If you have a $400,000 loan at a 5% interest rate spread over a 30-year term, you will end up paying the bank approximately $373,158 solely in interest charges throughout the life of that loan. If you haven't utilized a home equity line of credit or refinanced your loan, the assumption is that you could potentially save a significant amount of money by paying off your mortgage ahead of schedule. This could prevent you from paying a substantial sum of money in interest to the bank, potentially in the tens or even hundreds of thousands of dollars. Additionally, paying off your mortgage early would also allow you to eliminate one of your monthly bills. For many individuals, the elimination of this expense can make a crucial difference in their ability to retire or not. Now, let's explore the top 10 strategies that individuals can employ to expedite the process of paying off their mortgage more quickly. Strategy 1. Bi-weekly payments. Firstly, let's discuss strategy number 1, which involves making bi-weekly payments on your mortgage. You may have come across this strategy before, but you might not fully grasp its workings or the impact it can have on your mortgage. Typically, people make monthly mortgage payments, resulting in 12 payments per year. However, some banks allow you to make a half payment every 2 weeks instead. This arrangement adds up to 26 half payments or 13 full payments annually. Consequently, you end up making an extra mortgage payment each year, but since you are paying it bi-weekly, you won't experience a significant change in your monthly expenses. At this point, you might wonder how much of a difference one additional payment per year can actually make. The answer is that it can make a substantial difference. For instance, if you have a $400,000 loan with a 5% interest rate and a 30-year term, opting for bi-weekly payments would enable you to pay off your mortgage 4 years 10 months early and save over $70,353 in interest. To determine the impact of bi-weekly payments on your specific mortgage, you can visit my favorite online calculator, which is available on davaramsey.com. You'll find the link in the description. Strategy 2. Make extra lump sum payments. My second strategy is quite similar to the first one, but it's structured slightly differently, and it's the approach I personally follow. It involves keeping your monthly payments unchanged while making additional payments towards the principal every month. To achieve a similar benefit as the previous example, here's what you can do. Take 1 month's mortgage payment and divide it by 12. Add that resulting amount to each of your 12 monthly mortgage payments. Personally, I find it easier to track this method rather than making bi-weekly payments. Using our example of a $400,000 loan, your monthly payments would be approximately $2,147. Dividing that by 12 gives you $179 per month. By adding $179 to each monthly mortgage payment, you effectively make 1 extra mortgage payment per year. However, you don't have to stop at just 1 extra mortgage payment per year. If you increase the additional monthly amount to $200, you would save $74,137 in interest over the life of the loan and pay off your mortgage 5 years and 2 months earlier. Alternatively, if you can manage to make the equivalent of 1 extra mortgage payment every quarter instead of annually, you would save over $173,176 in interest over the life of the loan and pay off your mortgage 12 years and 6 months earlier. The best part about this strategy is its complete flexibility. You can choose to make these extra mortgage payments or pause them as you please. In contrast, if you opt for a 15-year mortgage instead of a 30-year mortgage, you're obligated to make higher mortgage payments without the option to adjust them at will. That's why I personally appreciate the flexibility of a 30-year loan coupled with the ability to make extra principal payments each month. It allows me to control when and how much extra I contribute, giving me the freedom to increase, decrease, or halt the additional payments as needed. Strategy 3. Make a one-time payment to your principal. The next strategy I recommend is to make a lump sum payment towards your mortgage principal. Imagine receiving a windfall of money, such as a tax refund, inheritance, or a work bonus. You can take that sum and directly apply it to the principal of your mortgage. For instance, in our previous example with a $400,000 loan, Making a $20,000 payment towards the principal at the beginning of the loan would yield significant benefits. It would save you over $62,254 in interest over the mortgage's lifetime and allow you to pay off the loan 3 years and 2 months earlier. By demonstrating the substantial impact that additional payments towards the principal can have, it becomes evident how advantageous it is to seize opportunities like receiving extra funds and allocating them towards your mortgage. Strategy 4. Do not take large amount of loan. My next strategy may appear straightforward, but it holds true. Avoid taking out a large mortgage in the first place. Just because the bank approves you for a $600,000 loan doesn't necessarily mean you should acquire such a substantial amount. If your ultimate goal is to pay off your mortgage and live a debt-free life, you must ask yourself whether that objective takes precedence over having a spacious home, a large yard, or a 2-car garage. For some individuals, these material possessions outweigh the desire for financial freedom. Consider this scenario. If you're nearing retirement, it's essential to evaluate whether downsizing is a viable option for reducing your mortgage debt. Could you transition from owning a detached home to residing in a more affordable townhome that costs $50,000 less? Alternatively, could you explore the possibility of living in a condo that is $100,000 cheaper? Are you open to relocating to an area with more affordable housing, even if it means a longer commute to work? Perhaps relocating to a state like Delaware, which boasts lower property taxes, school taxes, or sales tax, could be financially advantageous. By doing so, you could redirect the savings towards paying down your mortgage principal. If paying off your mortgage and achieving a debt-free lifestyle genuinely ranks as your top priority, then it's crucial to seriously consider these alternative options. Strategy 5. Increase your income. The next strategy I suggest may seem like common sense, but it's highly effective. Increase your income. As you continue working with a particular company, it's likely that you'll receive raises along the way. One popular approach is to maintain your current living expenses whenever you get a raise and instead allocate the additional income towards your mortgage principal. Another strategy I appreciate involves utilizing your property itself to generate extra income. Platforms like Airbnb provide opportunities to rent out a spare room or even an entire floor of your home for short periods, spanning a few days or weeks. Some individuals have even constructed sheds on their properties and rented them out as storage spaces or charged fees for parking RVs or boats on their land. Additionally, I highly recommend exploring side hustles. In today's world, it has never been easier to engage in a side hustle. For instance, I consider creating YouTube videos, such as the one you're watching now, as my side hustle, generating a few $1,000s annually. Websites like Etsy.com, Fiverr.com, and Upwork.com offer avenues for freelancers to earn income by undertaking various tasks remotely, ranging from graphic design and woodworking to administrative work and blog post writing. Whatever skills you possess, you can monetize them on these platforms. Furthermore, services like Uber and Lyft provide the opportunity to earn extra money by driving cars on your own schedule, potentially generating a few $100s per month. In summary, increasing your income through various means, such as leveraging raises, utilizing your property, and engaging in side hustles, can significantly aid in accelerating your mortgage payoff journey. Strategy 6. Reduce expenses. Strategy number 6 focuses on reducing your expenses. Every dollar saved is an additional dollar that can be allocated towards your mortgage principal without significantly impacting your quality of life. It's important to evaluate your monthly expenses and identify areas where you can make adjustments. Ask yourself if there are any expenses you can live without. For instance, could you downgrade to a slightly slower internet speed and save $20 per month? Is it possible to forego subscriptions like Netflix, Hulu, or Disney+? Can you extend the lifespan of your phone, opting to upgrade every few years instead of annually and paying it off monthly? Instead of dining out once a week, could you limit it to once a month? Take a comprehensive look at all your monthly expenses and once again consider whether each expense holds a higher priority than paying off your mortgage early. By making conscious choices to reduce expenses, you can free up more funds to accelerate your mortgage repayment. Strategy 7. Maximize your credit card rewards. Strategy number 7 revolves around maximizing your credit card rewards. While I generally advise caution with credit cards, the truth is that if you're not taking advantage of reward programs, you're essentially subsidizing those who do. Certain cards offer lucrative benefits such as up to 5% cash back on groceries, gas stations, and even Amazon.com. If you're already spending money in these categories on a monthly basis, it makes sense to use your credit card and earn that 5% back. The key is to ensure that every time you redeem your reward points for cash, you make an equivalent one-time payment towards your mortgage. By doing so, you can channel those earnings directly into paying down your mortgage principal. If you consistently put all your living expenses on a rewards credit card, these additional payments can accumulate to several $1,000s per year, potentially saving you tens of thousands of dollars in interest and enabling you to pay off your mortgage a few years ahead of schedule. However, it's important to approach this strategy with caution. It can be a risky game to play, and you must diligently pay off your entire credit card balance each month to avoid interest charges. Responsible and disciplined credit card management is crucial when pursuing credit card rewards as a means to accelerate your mortgage payoff. Strategy 8. Create a household budget. To pay off your mortgage faster, creating and adhering to a budget is crucial. Track your income and expenses. Take stock of your monthly income from all sources. Then, track your expenses over a few months to understand your spending patterns and identify areas where you can cut back. Trim non-essential expenses. Review your discretionary spending and find areas where you can make cuts. Reduce dining out, entertainment subscriptions, and unnecessary purchases to free up more money for your mortgage. Build an emergency fund. Set aside a portion of your budget for an emergency fund. Having savings will prevent financial setbacks and ensure you can continue making mortgage payments on time. Regularly review and adjust your budget. Keep a close eye on your budget and make adjustments as needed. Monitor your progress, identify areas for improvement, and stay committed to your financial goals. Strategy 9. Negotiate a lower interest rate. One effective way to pay off your mortgage faster is to negotiate a lower interest rate with your lender. Contact your lender and inquire about refinancing options or discuss the possibility of lowering your interest rate on the current loan. A lower interest rate can result in reduced monthly payments and more of your payment going towards the principal, allowing you to pay off the mortgage faster. However, keep in mind that refinancing may involve closing costs, so it's important to weigh the potential savings against the associated expenses to ensure it makes financial sense for you in the long run. Strategy 10. Avoid taking on additional debt. To expedite your mortgage repayment, it's crucial to avoid taking on additional debt. Accumulating new loans or credit card balances can strain your finances and hinder your ability to allocate extra funds towards your mortgage. Minimize unnecessary purchases and focus on paying off existing debts to free up more money for mortgage payments. By prioritizing debt reduction and avoiding new liabilities, you can direct more resources towards your mortgage, paying it off faster and saving on long-term interest costs. Practicing financial discipline and living within your means are key elements in achieving mortgage freedom. Finally, let's examine our example of a $400,000 loan at a 5% interest rate over 30 years. In the initial payment, only $480 is allocated towards the principal, while a substantial $1,666 goes towards interest. As time passes, the portion dedicated to the principal gradually increases. After 10 years, $791 is applied to the principal, with $1,355 covering the interest. By the 20-year mark, $1,303 is contributed towards the principal, leaving $843 for interest. Finally, on the last payment after 30 years, $2,135 is designated for the principal, while $8 is allotted for interest. These numbers reveal that the bank benefits most from keeping borrowers in the early years of a 30-year mortgage. It is crucial to consider your position in the amortization schedule and the amount of each payment that goes towards the principal, even if the bank offers a lower interest rate and monthly payment. Falling into this common trap can be detrimental. Thank you for watching until the end. And remember to subscribe for more financial strategy videos. See you in the next one.
This is a brand new channel. If you find any values from this video, please subscribe and like.
Your support will help us to stay motivated and keep this channel running. We are committed to providing you the best possible service.